Okay, let's unpack this. Have you ever just looked at the sheer volume of information out there on currency exchange rates? You've got economic reports, central bank statements, trade data, capital flows. It's
Yeah,
overwhelming, right?
absolutely.
And you think, how on earth does anyone actually cut through all that noise to figure out what a currency is really supposed to be worth, beyond the minute-to-minute ups and downs?
Yeah, what's the real underlying value? It's a massive challenge. And it's really at the heart of international finance.
Hmm.
I mean, the market rate you see flashing on the screen, that's just a snapshot.
Right.
It's influenced by countless factors, and honestly, a lot of them are pretty short term. But economists, institutions, they need some way to gauge if that market rate is, like, totally out of whack with a country's basic economic health.
And that's exactly what we're diving into today. We've got this great set of sources from you, our listener, exploring one specific, pretty powerful framework economists use to try and estimate that long-term value. It's called the Macroeconomic Balance Approach.
Hmm.
Think of this as like one of the main tools places like the IMF use when they try and put a number on what a currency should look like, assuming its economy is running sustainably.
Exactly. And our mission here for this deep dive is basically to take those sources you sent, try to cut through some of the technical jargon,
Yeah, there can be a bit of that.
and pull out the really essential nuggets.
Yeah.
We want to help you understand what this macroeconomic balance approach, or MB, actually is, where it came from, how it tries to answer that really tough question about currency value.
And why it matters.
And crucially, yeah, why it matters, or sometimes, why it maybe doesn't give you the whole picture.
Okay, so we're going to trace its history a bit, get into the nuts and bolts of how it works, see how it stacks up against other ways people value currencies,
Uh-huh.
talk about where it's actually used in the real world, and maybe most importantly, highlight when it's a really useful lens and frankly, when it kind of breaks down.
Sounds good. So let's start right at the beginning. At its core, this macroeconomic balance approach, the MB approach, it's basically a method to estimate something called the equilibrium real exchange rate, or ERER sometimes.
Okay, equilibrium real exchange rate. What's that?
It's the level of the real exchange rate.
Okay.
So adjusted for inflation differences, that's consistent with a country achieving both internal and external economic balance over the medium to long term, that is. It's about finding that kind of economic sweet spot.
Right, like a sustainable level. And this idea, it didn't just pop up recently, did it? The sources mentioned it goes back a bit.
Oh, yeah, definitely. The sort of analytical roots, they go back to Swan in 1963. But it was really developed and refined quite significantly by economists at the IMF, the International Monetary Fund, mostly during the 1970s.
Okay, so the IMF has been involved from early on. Was there anyone in particular who really pushed this approach forward?
Yeah, the name that really comes up is John Williamson. He did a lot of work on what he called fundamental equilibrium exchange rates, or FEERs. FEERs are basically a specific application of the MB framework.
Oh, okay.
And Williamson really popularized this idea of defining that equilibrium rate as the one needed to hit two key targets at the same time: internal balance and external balance.
Okay, let's break those down. Internal balance, what does that mean in practice?
Internal balance basically means the economy is humming along at its potential. It's producing about as much as it sustainably can without, overheating and causing lots of inflation or sputtering along with high unemployment.
So stable prices, full-ish employment, kind of stripping out the boom and bust cycles,
Exactly. You're looking at the underlying productive capacity.
and external balance.
External balance is about having a sustainable position with the rest of the world. Specifically, it usually focuses on having a sustainable current account position.
And sustainable doesn't just mean zero, right?
No, not necessarily. It means a current account balance, whether that's a surplus or a deficit, that's consistent with the country's medium-term fundamentals. Things like its demographics, its government's fiscal stance, its level of foreign investments. It's a balance that the country can theoretically maintain over time without building up, say, excessive foreign debt or accumulating assets way out of line with its economy.
Okay, so the MB approach is trying to find the exchange rate that makes everything look just right internally, externally, based on these deeper, longer-term factors.
You got it. And because it's such a comprehensive way of looking at things, the sources point out that the IMF's special group on exchange rates, the CGER, really leaned heavily on this approach for their quantitative currency assessments, starting back in the mid-90s.
And that evolved into something they still use today.
Yes, that work eventually morphed into the IMF's current framework, which is called the External Balance Assessment, or EBA. And that EBA is probably the most prominent real-world application of the MB approach that's happening right now.
That makes sense. If the IMF relies on it that heavily, it must have some practical use for checking up on global economies. So let's step away from the theory for a second. Why do institutions, analysts, why do they actually use this MB approach? What's its job in the Forex world?
Well, its main job definitely isn't predicting where the euro is going tomorrow. It's really about analysis over the medium to long term. Think years, not days or weeks.
Okay.
Its primary goal is to calculate that equilibrium exchange rate, the real rate that sort of fits with a nation's fundamental macro picture when it's balanced both internally and externally.
And once you have that number, that estimate, you can compare it to where the market rate actually is.
Precisely. That's where it becomes useful for assessing potential misalignment. You take the current real exchange rate from the market, compare it to the MB estimate of where it should be in equilibrium, and that helps you identify if a currency might be significantly overvalued or undervalued compared to its long-run fundamentals.
The sources brought up some classic examples of this, didn't they?
They did, yeah.
Yeah.
Like the US dollar back in 1985, a lot of MB models at the time were basically screaming that it was way overvalued.
Why was that?
Well, the thinking was the U.S. economy was maybe running a bit too hot, operating above its sustainable potential, and that was contributing to this huge, unsustainable current account deficit. The model flagged that disconnect.
Okay.
And then on the flip side, around the year 2000, you had numerous studies using MB approaches, looking at the brand new euro and concluding it was like really significantly undervalued based on the Eurozone's economic fundamentals.
So these are cases where the model pointed to really big gaps between the market and the estimated fundamental value.
Exactly. Big persistent gaps that seemed hard to explain just by short-term market sentiment or flows.
And can that kind of analysis actually influence policy, like what governments or central banks might do?
Oh, absolutely. If this kind of framework suggests a currency is way out of line with its fundamentals, it can be a signal to policymakers. Maybe our fiscal policy is too loose, or maybe monetary policy needs adjustment to help guide the economy, by extension the currency, back towards a more sustainable path.
So it feeds into those big policy discussions.
For sure. It's a key input for the IMF when they do their annual checkups on member countries, those Article 4 consultations. They explicitly assess whether exchange rates seem consistent with medium-term fundamentals, and MBIBA is a big part of that assessment.
Okay, so if I'm, say, an investor or maybe a treasurer at a company dealing with currency risk, is this MB approach something I'd use to decide, should I buy or sell Japanese yen tomorrow morning?
Right, and the sources are super clear on this, and it's really, really important to get this. The macroeconomic balance approach is not a short-term trading tool. Full stop.
Okay, not for timing the market.
Not at all. It's meant to be a long-term benchmark. Maybe think of it as an anchor. It can inform strategic decisions for investors with a really long time horizon, years potentially, or for businesses thinking about managing their currency exposure over the long haul. But, and this is a big but, the estimates themselves have significant uncertainty built in, and they give you absolutely zero signal about when the market might actually move towards that estimated equilibrium.
Right, so it's more about understanding the potential long-run direction or misalignment, not the timing or the path to get there?
Precisely. It's about the why in the long run, not the when in the short term.
Okay, so let's dig into the how then. How does this MB approach actually work? What are the core economic ideas it's built on?
Okay, so it really rests on those key assumptions we touched on. First, this idea of internal balance. We're kind of conceptually freezing the economy at a point where it's operating at potential output with stable inflation. So no distortions from temporary booms or busts.
Got it. Adjusting for the business cycle, essentially.
Right. And second, external balance, which means we're assuming a sustainable current account position.
That CA or K norm thing.
Exactly.
Yeah.
The key norm in the IMF's framework. And remember, this sustainable level, it's tied to those medium-term fundamentals, like demographics, government policy choices, the country's net foreign asset position. It's the level that should be sustainable going forward, not necessarily zero.
And this all ties back to a pretty fundamental economic identity, doesn't it?
It does, yeah. The national income identity. It simply states that the current account balance, CUR, is equal to national saving, S, minus domestic investment, II. So CUR equals SI.
Simple equation, but powerful.
Incredibly powerful, because it tells you that a country's balance with the rest of the world, its current account, is fundamentally a reflection of its own saving and investment behavior. If a country saves more than it invests domestically, it runs a surplus. If it invests more than it saves, it runs a deficit. And the MB framework recognizes that all those deep macroeconomic factors we mentioned, interest rates, inflation, government spending, demographics, level of development, existing foreign wealth, all of these things influence a nation's overall saving and investment decisions.
So they must logically influence what a normal or sustainable current account balance should look like for that country.
Exactly. That's the core link.
Right.
These fundamentals drive the SI balance, which determines the sustainable current account, the CAN-norm.
Okay, so that's the theory. How does the IMF's EBA approach the practical MB application actually calculate this stuff? The sources laid out some steps.
Yeah, they did. It's roughly a three-step process. Step one is basically using historical data to estimate the relationship between a country's current account and a whole bunch of these fundamental drivers.
So looking backwards first.
Right. Economists use statistical techniques, often panel data covering many countries over many years, to figure out, on average, how much things like demographic shifts or changes in government budgets or oil prices have typically affected current account balances in the past.
So you build a model based on history. If a country looks like this fundamentally, its current account tends to be that.
Pretty much, yeah. You're capturing those historical correlations.
Okay, step one, understand the past links. What's step two?
Step two is calculating the norm current account, the K-ORM. This is where it gets interesting. You take that historical relationship you just estimated, but now you plug in the values for all those fundamental drivers that are considered sustainable or desirable for the medium term.
Ah, so not necessarily the current values, but the target or projected sustainable value.
Exactly. You ask the model, okay, based on how things usually work, what should this country's current account balance be if its policies were set at desirable levels and its fundamental characteristics were at their projected medium-term equilibrium levels? That gives you the K-norm, the target current account, consistent with overall balance.
Got it. So K-norm is the medium-term target. How do you get from that target to figuring out if the exchange rate needs to change?
Okay, that's step three. Now you compare that K-norm target to the country's underlying current account.
Underlying, not just the actual current account.
Right, the underlying current account is the actual reported CA, but adjusted to remove the temporary effects of the business cycle. For instance, if the economy is in a deep recession, imports might collapse temporarily, making the actual CA look better than it would be if the economy were running normally. You need to adjust for that, for output gaps, both at home and abroad.
Okay, so you compare the target K-norm with the cycle-adjusted actual underlying CA. That difference is the CA gap.
Precisely. CA gap equals K-norm underlying CA. Now, if this gap is positive, what does that mean? It means the K-norm is higher than the underlying CA. In other words, the country's underlying current account is weaker, maybe a smaller surplus or a bigger deficit than the model says it should be for medium-term balance.
Okay, so a positive CA gap means the actual current account is too weak. How does the exchange rate fix that?
Right, the exchange rate is seen as the key adjustment mechanism. To close that positive CA gap, to strengthen the current account towards the norm, the real exchange rate generally needs to move. You need an estimate of how sensitive the current account is to changes in the real exchange rate. Economists call this the trade elasticity.
Okay.
The sources give a formula, roughly. The required change in the log of the real exchange rate, RER, is the CA gap divided by this elasticity. So if the CA gap is positive, actual CA too weak, the formula implies the currency needs to weaken. The RER needs to increase to make exports cheaper, imports more expensive, and thus improve the current account back towards the Cannon norm.
Let me see if I have this straight. Positive CA gap means the current account is weaker than the norm. This implies the currency is currently overvalued relative to the level needed to fix the CA. Therefore, the currency needs to depreciate, meaning the RER index needs to increase. Did I get that logic?
Yes, that's the core economic logic flowing from the CA gap calculation and the need for adjustment. Now, here's a crucial point about how the final results are often presented, particularly by the IMF in their EBA.
Okay.
They often report the final result as an ERER gap, a real effective exchange rate gap. And in their convention, a positive ERER gap actually indicates that the currency is assessed as being undervalued.
Wait, undervalued? But we just said a positive CA gap implies the currency is overvalued and needs to weaken.
I know, it seems backwards at first glance. Think of it this way. The positive CA gap tells us the CA needs to improve. That improvement requires a depreciation, a higher RER. If the actual RER is currently below the estimated equilibrium RER needed to achieve that CAN-norm, then the actual currency is considered undervalued relative to that equilibrium. So the IMF's positive ERER gap signifies that the current market rate is lower, more depreciated, than their final estimate of the equilibrium rate. It's a difference in sign convention between the implication of the CA gap itself, overvaluation needing depreciation, and the final reported rear gap. Positive means undervalued relative to equilibrium.
Okay, that's a really important distinction. The CA gap logic points one way regarding current over-undervaluation, but the final reported rear gap uses the opposite sign convention to state the conclusion relative to the equilibrium. You need to keep that straight when reading the reports.
Definitely, it's a common source of confusion and something you just have to be aware of when looking at EBA results.
Got it. And the sources mentioned briefly, there's another way to do this within the MB family.
Yeah, just quickly, some alternative models, like one associated with Peter Montiel, they approach the calculation differently. Instead of defining the CAN-norm first and then solving for the RER adjustment, they build a more complex system of equations where things like the current account and the net foreign asset position are determined within the model simultaneously, and they solve directly for the RER that makes everything balance out.
Different path, same goal. Find that equilibrium rate.
Essentially, yes. Different computational route to the same conceptual destination.
Okay, so that's the MB framework in, well, maybe not in a nutshell, but unpacked a bit. How does it compare to other ways people try to figure out what a currency is worth?
Right. It's definitely not the only game in town. It's just one approach to estimating these equilibrium exchange rates, or EERs. Let's compare it to a couple of the big ones.
Like the classic Purchasing Power Parity,
Mm-hmm.
PPP.
Yeah, PPP is probably the simplest idea. The basic concept is that exchange rates should adjust over time so that a basket of goods costs the same whether you buy it here or abroad once you convert the currency. Law of one price, basically. In its purest form, it implies the real exchange rate should be constant.
Okay, simple idea. How does MB stack up against that?
Well, MB is way, way more complex. PPP just looks at relative prices. MB brings in the whole macro, picture saving, investment, government policy, demographics, productivity, the whole shebang.
And does PPP actually work?
That's the famous PPP puzzle. In reality, exchange rates often deviate from PPP levels by huge amounts and for really long times. PPP might, maybe, have some predictive power over very, very long horizons, decades, perhaps, but its core assumption that the real exchange rate should be constant doesn't hold up well because the underlying economic structures driving savings, investment, productivity, they all change. MB is specifically designed to let that equilibrium real rate change as the fundamentals change.
Okay, so MB is more dynamic, more complex than PPP. What about interest rate parity, IRP?
IRP is a totally different animal, really. It's about the relationship between interest rate differentials between countries and the forward exchange rate. It's driven by arbitrage. Investors shouldn't be able to make risk-free money just by borrowing in one currency and lending in another. So it's really an equilibrium condition for financial markets for asset prices.
Whereas MB is more about...
MB is fundamentally about the real economy. The balance of savings, investment, and the flow of goods and services reflected in the current account. Now, obviously, real interest rates can influence saving and investment decisions, so they can feed into the calculation of the Gannon norm within the MB framework.
Sure.
But the MB approach itself isn't derived from IRP. It's focused on that real-side equilibrium.
Gotcha. And there was another one mentioned, BEER, Behavioral Equilibrium Exchange Rate. That sounds closer to MB.
It is closer, yeah. BEER also uses macroeconomic fundamentals. It's more of an econometric approach where you statistically link the observed real exchange rate over time to a set of observed fundamental variables, things like productivity differences, the terms of trade, net foreign assets, maybe real interest rate differentials. The equilibrium rate is then estimated based on the current or recent values of those fundamentals.
Yeah.
It explains the historical behavior.
So what's the key difference between BEER and MB then? They both use fundamentals.
The main difference often highlighted is that MB, especially in its fear variant associated with Williamson, tends to be more normative. It's asking what the exchange rate should be if the economy were operating at potential output with sustainable current accounts and desirable policies.
Okay, more prescriptive.
Exactly. BEER is generally considered more positive or descriptive. It's trying to explain what the exchange rate has typically been, given the actual observed levels of fundamentals, whether those levels were sustainable or not. A key practical difference is that MB requires you to explicitly define that CAN-norm, that sustainable current account target, which involves some judgment. BEER doesn't usually require that step.
And how do they compare in terms of, like, predicting things?
Well, that's where it gets interesting. The sources suggest that when you actually test their forecasting ability, BEER, and sometimes even simple PPP often perform just as well as, or even better than, the more complex MB models, especially over shorter horizons. MB tends to perform worst in pure forecasting bake-offs.
Huh. So if we think about that comparison table concept from the sources, MB sounds like it's high on complexity, definitely needs a ton of data,
Oh, yeah.
but it gives you a really strong economic story, great interpretability for why things might be misaligned, but maybe not the best crystal ball for forecasting.
That really nails the core trade-off. MB offers this deep, economically grounded narrative for understanding medium-term deviations. It's built on theory, but it's not designed for prediction or timing, and its complexity means it relies heavily on data and assumptions. PPP is simple, needs less data, but the interpretation is weak, and it's often miles away from the market for ages. BEER sits somewhere in the middle, uses fundamentals, but maybe less theory-heavy, better forecasting than MB sometimes.
Okay, let's get practical again. Putting MB to work. You said it needs a ton of data. What kind of stuff are we talking about exactly?
We are talking a lot of data. I mean, you need detailed current account breakdowns, GDP, potential GDP estimates, inflation, various interest rates, nominal and real exchange rates, often effective rates against many trading partners, government budget balances, public debt levels, demographic projections like old age dependency ratios, estimates of the country's net international investment position, NIR or NFA over time, terms of trade indices. Yeah, the list goes on. You're pulling this from big international databases like the IMF's World Economic Outlook or International Financial Statistics, from central banks like the ECB or the Fed, national statistics offices, the OECD, and sometimes commercial providers too. It's a major data gathering exercise.
And I imagine just processing all that isn't straightforward either.
Oh, not at all. It's incredibly complex. You're often working with these large panel data sets, many countries, many years. You have to make sure everything's comparable, deal with seasonal adjustments, choose consistent base years for indices. And then there's the huge challenge of estimating the variables you can't actually see.
Like potential output.
Exactly.
Yeah.
Estimating potential output is notoriously tricky.
Yeah.
And estimating that underlying current account, the one adjusted for business cycles, that requires estimating output gaps not just for your country, but for its trading partners too, and estimating how imports and exports respond to those cyclical changes. It involves a lot of econometric modeling itself.
And you need it all to add up globally.
Right. For global consistency, the world's current account balances should technically sum to zero or close to it. So you often need to ensure your country-level estimates are consistent within a global framework. All these layers of estimation and adjustment inevitably introduce uncertainty into the final MB results. It's not a precise science.
Okay, so given all that complexity, and we heard the forecasting track record isn't stellar, how do researchers even backtest an MB model? What are they actually looking for, if not trading profits?
That's a great question. You're right, backtesting MB isn't about finding a profitable trading strategy. It's more about checking if the model's underlying logic seems to hold up historically. Did the model's estimates of the K-norm and the resulting CA gaps actually correspond, in hindsight, to periods where the currency seemed fundamentally misaligned or was undergoing significant adjustment?
So does the model story match the historical narrative?
Exactly. Like that Reserve Bank of Australia study mentioned in the sources they'd use historical data to see if their specific MB model for Australia did a decent job of tracking the medium-term swings in Australia's actual current account. Does the model capture the key drivers that seemed important historically? You're also looking at the stability of the estimated relationships over time. Do the elasticities jump around wildly?
Okay.
You can compare its out-of-sample forecasts to simpler models, like a random walk, using standard metrics like root mean squared error. But as the sources confirm, MB usually doesn't shine there. That just reinforces that its primary value isn't prediction, but providing that structured fundamental assessment for the medium to long term.
Let's make this even more concrete. The sources gave us a real-world example. The IMF's EBA results for the euro area.
Right. This is probably the most visible, ongoing application of the MB approach. The IMF publishes these EBA estimates regularly for major economies, giving their view on current account gaps and the implied exchange rate misalignments.
And the sources provided the numbers for the euro area for 2022 and 2023. What did they show?
Okay, so for 2022, the IMF's estimate for the euro area's total CA gap was positive 0.5% of GDP.
Okay, positive CA gap means underlying current account was weaker than the norm.
Exactly. Estimated to be 0.5% of GDP, weaker than the level consistent with fundamentals and desirable policies. Now, the corresponding total wear gap was estimated to be positive around plus 7.6% or plus 8.0%, depending on the specific EBA model variant.
And remembering the sign convention, a positive ERER gap in the IMF's report means the currency is assessed as being
Undervalued. So the IMF's assessment for 2022 using this MB-based EBA framework was that the euro was significantly undervalued relative to where its fundamentals suggested it should be in the medium term.
interesting. What about 2023?
For 2023, the picture was broadly similar. The estimated total CA gap actually widened a bit to a positive 1.0% of GDP, suggesting the underlying CA was even weaker relative to the norm. The total ERER gap remained positive, still indicating undervaluation, although the magnitude narrowed slightly to around plus 5.5% or plus 3.9%.
So consistently undervalued in both years, according to this framework, implying, based purely on these fundamentals, there was scope for the euro to appreciate over the medium term.
That was the basic implication from the IMF's analysis, yes. And the sources also mentioned that things called policy gaps, like if fiscal policy isn't quite at the desirable level assumed in the norm, and residuals, which are just the unexplained parts, also contribute to these final gap estimates.
Okay, so if it's not really for generating short-term trading signals, how do people use this kind of analysis strategically?
The main strategic use is identifying potentially large and persistent misalignments. We're not talking about a 2% deviation, but maybe, as the sources hint, something in the range of 10-15% or even more away from the estimated equilibrium band.
Okay, big deviations.
Right. For very long-term investors, think large asset managers, sovereign wealth funds, pension funds. This kind of analysis can provide a strategic directional bias for positions they might hold for years. If a currency looks massively undervalued based on this deep fundamental work, they might slowly build a long position over time, using it as a core view.
And for companies?
Similarly, a multinational corporation looking at its long-term currency exposures might use these kinds of estimates to inform its strategic hedging decisions. Should we be hedging more or less of our euro receivables over the next 5 years based on this long-term fundamental view?
But crucially, they'd still need something else to figure out when to actually put on that trade or adjust that hedge.
Absolutely non-negotiable. MB might suggest the euro is undervalued long-term, but it tells you nothing about whether it might fall another 5% first or when it might start to turn. You absolutely have to combine this strategic fundamental view with other analysis, looking at the business cycle, using technical analysis for entry-exit points, tracking capital flows, monitoring market sentiment to get any sense of timing.
Right. MB provides the backdrop, not the trigger.
Exactly.
And trying to simulate trading profits based only on MB signals, the sources suggested that usually looks pretty bad.
Yes, generally poor results, and they explain why. First, these misalignments can last for years. You could be holding a position based on undervaluation and watch the currency go down, down, down for a long time before it corrects huge drawdowns. Second, no timing signals. Third, the results are very sensitive to the specific assumptions you make in the model. Fourth, practical costs like carry or swap points can eat away at returns, especially if the misalignment persists.
So its value isn't generating alpha directly.
No. Its real value lies in helping to explain past large currency moves in a structured way and providing that fundamental anchor for long-term strategic thinking, not in generating easily simulated trading profits.
Okay, let's try and synthesize this. Thinking about the conditions, when does this macroeconomic balance approach really shine? When is it most useful?
It really comes into its own for medium to long-term analysis. We're talking horizons of 2 to 5 years, or even longer. It's particularly powerful for identifying those potentially large, sustained misalignments that suggest something fundamental is out of kilter.
Okay.
It tends to work best or be most reliable in relatively stable macroeconomic environments. Times when the underlying relationships between savings, investment, trade, and the fundamentals are behaving somewhat predictably, it provides that invaluable long-term anchor for expectations about currency values.
And for policymakers.
Hugely important for informing macroeconomic policy discussions and for international surveillance like the IMF's work we discussed. And just generally, it really deepens your understanding of the fundamental economic forces that should, in theory, drive currencies over the long haul.
But there's always a but. When does this sophisticated framework tend to struggle or even completely fall apart?
The big one, the major Achilles heel that the sources really hammer home, is during periods of high volatility and large macroeconomic shocks.
Like crises.
Exactly. Think about the global financial crisis in 08-09, or the euro debt crisis a few years later, or the massive shock from the COVID-19 pandemic. These kinds of events fundamentally disrupt the core assumptions of the MB model.
How so?
Well, first, the basic assumption that the economy is operating near some stable potential output goes out the window. Second, the underlying economic relationships themselves can become unstable during a crisis. How much does trade really respond to the exchange rate when global supply chains are broken? How does investment react when uncertainty is sky high?
Right, the model parameters might change.
Precisely. And maybe even more importantly, during crises, capital flows often become driven by factors completely unrelated to medium-term fundamentals. You get massive flights to quality where money pours into perceived safe havens, like the dollar or Swiss franc, regardless of their MB valuation. Or you get sudden stops where capital flees emerging markets, forcing huge currency depreciations that have little to do with their saving investment balance at that moment.
So fear and liquidity dominate.
Exactly. Fear, liquidity, risk sentiment, central bank emergency actions. These factors can completely overwhelm the slower-moving fundamental forces that MB tries to capture. It becomes incredibly difficult to separate the signal from the noise, and data lags make it even harder in real time. The historical examples mentioned GFC, Euro crisis, COVID, all showed periods where MB-based valuation seemed almost irrelevant in the face of overwhelming crisis dynamics.
So in really turbulent times, the model struggles to keep up with reality.
Pretty much. It's designed for analyzing the ship's course based on the stars and the currents. But when a hurricane hits, those calculations become much less useful for immediate navigation.
Okay, that was a really thorough exploration of the macroeconomic balance approach. It's clearly, a powerful analytical tool. Major institutions use it to get a handle on long-run currency drivers, flag those potential big misalignments, and inform strategic thinking for people with a long time horizon.
Absolutely. But, and it's a crucial but we've kept coming back to, it is explicitly not designed for, and honestly, not very effective at predicting short-term market moves or telling you when a perceived misalignment might actually correct, especially when the global economy hits rough patches.
Right. It's not a timing tool, particularly in volatile markets. But still, understanding a framework like this, even with all its limitations, I think it gives you a much richer appreciation for the forces at play in global currency markets, doesn't it? Something beyond just the daily headlines or the price charts.
Definitely. It provides that fundamental economic context, the potential why behind the market's movements, even if the when and how are driven by a whole host of other factors day to day.
Which leaves us with a final thought for you, our listener, to maybe mull over after this deep dive.
Yeah.
Given that these sophisticated, fundamentally based equilibrium estimates, like the ones from the Macroeconomic Balance Approach, can diverge from actual market rates by significant amounts, sometimes for years. And given the undeniable reality that the world economy gets hit by unpredictable shocks, pandemics, financial crises, geopolitical events that can completely throw those fundamental relationships off course, how much weight should someone realistically place on these long-term theoretical benchmarks when they're actually trying to navigate currency markets today in practice?
Good question.
Is it more of a tool for understanding the past and providing broad strategic context? Or can it still be a truly practical guide for making current investment or business decisions despite all the noise and uncertainty? Something to think about.
Indeed it is.
Well, thanks for joining us for this deep dive. We really hope it's given you some valuable insight into one of the key ways economists try to wrestle with that incredibly complex question of currency valuation.